Hi, I'm Lucas. I lead strategy and technology at Veloris Capital. Today we read the market signals the honest way. Right now, four of them lean constructive at once. Company earnings estimates are rising. Profit margins are getting wider. Investors have turned cautious, and July has a strong seasonal record. Here is the key idea. They do not all deserve equal weight. Rising earnings and wider margins are the firmest because they look forward at real company results. Cautious positioning is useful but noisier. The calendar is the softest of all, so we take them strongest first and flag what could prove each one wrong. Let's start with the strongest signal, what companies are actually expected to earn. This chart shows it. The bars are the S&P 500's earnings per share for each quarter of 2026. Earnings per share is simply a company's profit divided by its number of shares. The figure analysts settle on is called the consensus, which just means the average of many professional forecasts. And that consensus has been climbing all year. Analysts see about $81 in the second quarter, rising to roughly $88 in the third, and about $91 by the fourth. That is a steady move higher, quarter after quarter. Why does it matter? Because over time, share prices tend to follow earnings. When analysts keep raising their forecasts, it usually reflects real improvement in business results, not just a good mood. That is a firmer base for higher prices than sentiment alone. Now, the honest caveat: these are forecasts, not results. Analysts often trim their numbers as a quarter gets closer, and a real slowdown in growth would turn these revisions lower. So it is a firm signal, but it still has to prove itself. Rising earnings are even stronger when they come with wider profit margins. So what is a margin? It measures how much of each dollar of sales a company keeps as profit after all its costs and taxes. A higher margin means the company keeps more of every dollar it earns. This chart shows where analysts expect S&P 500 margins to go. In 2025, the consensus net profit margin sits near 13.3%. It is seen rising to about 14.9% in 2026 and to 16.4% by 2027. If those forecasts hold, companies would turn more of their sales into profit each year. That is the engine behind the rising earnings we just saw. But look at the size of the climb. Moving from 13.3 to 16.4% is a big jump that still has to happen. Higher wages, higher input costs, or new tariffs could stall it. A tariff, by the way, is just a tax on imported goods. If margins stall, the whole earnings case softens with them. So this signal is firm too, but not yet delivered. Our next two signals are weaker, so they get less weight. First, positioning. How investors have actually placed their money. Lately, more traders have been buying protection against falling prices. And in one weekly government report, large speculative traders were positioned for the market to fall, not rise, as of late June. So why treat caution as a good sign? Because markets often turn when too many people expect the same thing. If most traders are already braced for a drop, much of the selling may be done. That is called a contrarian signal, meaning it works against the crowd, but it is only moderate. Caution can linger for weeks, and sometimes it is right. Our softest signal is the calendar. Over the last 20 years, July finished higher about 80 to 85% of the time, with an average gain above 2.5%. That sounds strong, but there are only about 20 Julys to study. It would not pass a strict statistical test. We treat it as a gentle nudge, nothing more. So the four signals lean constructive, but no honest read points only one way. Two bigger risks sit above them all. First, the backdrop. Interest rates that stay higher for longer would weigh on prices, whatever earnings do. So would fresh inflation or a shock on trade or taxes. And after a strong run, plenty of optimism may already sit in prices. Second, and closer to home, if we knew a rally was coming, A fully invested account would make sense. Ours is not. Our risk overlay currently holds about 49% of the book in stocks and the rest in cash, a setting we call cruising. Every night, the system recalculates more than 20 risk indicators and sets our exposure for the next day. It reads today's conditions, not a forecast. So our own process is only about half invested, and that tells you more than any single bullish signal. This is data-driven, not gut-driven. The optimizer decides which qualified names to hold, not how big each position should be. The overlay decides how much we own overall. So, read the signals as useful context, never a command. We let the process decide, not the forecast. If you'd like to follow along, Veloris Capital runs on eToro under the strategy name AlphaWizzard. If you choose to copy, eToro replicates our trades proportionally into your own account, and you stay in control at all times. Past performance is not an indication of future results. Your capital is at risk.